Very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajaya Sharma. The markets are stabilizing. In fact, after 9 bad days, we are looking at the Nifty and the Bank Nifty both trade at days high. Advanced decline is clearly favoring the gainers. But it has been very difficult first 8-9 days for traders, for investors. In fact, we've had 3 bad series, and data shows that after 3 consecutive bad series, the subsequent series actually starts rebounding. But one fund manager who has done phenomenally well, especially in their the mid-cap and the multi-cap end of the market funds, 5-star rating, is dropping by in our newsroom today. We have Saibal Ghosh who's dropping by in our newsroom to discuss markets, of course, from Aegon Life. Saibal, thanks very much for dropping by.
Thank you very much. It's been a fantastic setup.
Yes, so we have a lot of fund managers coming by and discussing their performance as well as their view in the market. So today you are in spotlight. So tell us, let's analyze where do we stand right now. Yes, you have navigated the space well, especially in your multi-cap and your mid-cap end of the portfolios. Both are in 5-star. Other two, 1 4-star and 3-star. But how did you manage to navigate mid-cap? That is one question I have in my mind, because that has been the most bruised space in the last 1 year.
There is actually, the first thing is that there is no magic sauce in this entire thing. I think our team has done extremely well on the bottoms-up approach. But also I must tell you that apart from the team, you also require a very sound process at this point of time. Because in this new information age, you are getting all the information at the same point of time. You should have a process to filter out the noise and take out the right information and then process it to take the decision. I think our team has done a fantastic job on this bottoms-up approach. So we have kept our fundamental focus very right. We have invested in stocks which has generated economic value for their business over a longer period of time, and which we got at a reasonable valuation.
Sure. So, let's come to the point which is really worrying the market right now. And last couple of days, the way entire momentum changed in the market, the moment they realize that the data is very strong in US, rate cuts may very well continue, and back home here as well.
Yeah.
And now, murmurs of perhaps slight deficit monsoon is also worrying. How meaningful are these worries for the market? Is the market justified in taking it so seriously that large part of the market is under pressure?
No, it is to some extent, it is a time to be cautious, no doubt about it. Because let me tell you that in last few years, our market has done very well because there has been a shift from unorganized to organized sector. So as a result, what happened that market has done much better than the underlying economy. Today we are seeing some kind of corrections where the market is at a very reasonable level. I would say that at a 10-year average multiple in terms of 1-year forward multiple, I think we are somewhere there, which is a comforting factor. But having said that, one very important risk which is brewing up and for which we don't have any clue at this point of time, that how the interest rate scenario is going to pan out, both globally as well as in domestic market. And once you have some visibility on the terminal rates, I think then the next question which we all are going to discuss is that, is it going to be higher for longer? We don't know. So those uncertainties is going to continue for some more time. But having said that, notwithstanding the market, there are always pockets where you have deep valuation. And
so let's come back to your mid-cap fund, which has performed very well. How is the earnings growth visibility of the biggest components? I want to understand, have you scaled back earnings in the new environment? That is something. And what are the feedback from some of the managements of these mid-cap companies on visibility from here?
See, commentary apart, I think what we see that there is definitely earning downgrade risk which is brewing up. If we see some high frequency data, the results are still mixed at this point of time. We are at this point of time seeing some green shoots on the rural demand side, but the urban demand is in a bad shape. We all know about it. So there would be risk.
Okay.
But little contrary to the market, I think we are very, very positive on IT. And we have taken some position. We think that that's going to play out well. Why? Because when we are concerned about the Western economy is going to slow down, but what we are forgetting that this slowdown will be on the back of high inflation. What it means that the nominal GDP will still be high, and the corporate profitability, corporate top lines are linked to the nominal GDP more. So from that point of view, we don't think that IT demand is going to come down big time. In fact, the commentary of IT companies are also collaborating to that fact.
NASSCOM
And the downside risk, earning downside risk, is lowest there. So
what else do you like apart from IT? Where is the contra call? We started building in positions gradually.
Not a contra call. We are not running a contra fund, but yes, I think we are positive on capital goods.
Okay.
Some kind of at some point of time, we would also like to see some of the new age companies
That's an amazing
which are the valuations are
getting in comfort zone.
And these guys, don't forget that they have exhibited their execution skill in past.
Sure.
And they are in a duopolistic or a monopolistic market.
So are you referring only to Zomato or even PB Fintech or others, delivery? What category of companies would you look at? Insurance, tech, beauty, or you would look at food delivery or even policy platforms?
I cannot name any particular stock. You understand, we are prohibited.
But
new age companies where there is some exclusivity, there is some kind of monopolistic, duopolistic approach, and they have exhibited their
plus change of heart now on profitability front. All of them common.
But having said that, one caveat is that in case if you have a higher for longer kind of interest rate scenario for quite some time, we don't expect that there will be a dramatic comeback of this stock. But these are good stock to hold.
So earnings growth, coming back, do you think your multi-cap portfolio, for example, blended small cap, mid cap, large cap, all of them put together, if a sorted portfolio can give earnings growth of 15 to 80%, 15 to 18% in the next 12 months or 4 quarters, or you think that's need to be moderated lower?
See, as a fund manager, we are not, our mandate is not to give a prediction of return.
No, earnings growth.
But I am saying that the normal fundamental thing is that over a longer period of time, this should reflect the nominal GDP growth.
And your current portfolios are exhibiting 15-18% earnings.
I mean, that's there for you. This is in public space, the performance.
But you also made a point that there is some downside risk, some trimming.
There is always a downside risk. When you are getting into equity, you have to be prepared for that.
This year has been very difficult for investors.
Very difficult.
What's the message you would give out to them? Should this year be taken, and how to prepare for next 2-3 years?
My suggestion to the investors is that please keep a focus on the asset allocation, because you make most of the money from asset allocation, not from stock picking or something of that sort.
Sure.
If you have allocated some money in equity and you have a long-term perspective, any time is good time as long as it's for a long time.
All right, Saibal, thanks very much.
Thank you very much. Thank you. It's been a pleasure. Thanks.
So that was Saibal Ghosh of Aegon Life talking about how they're running their portfolios and thoughts on parts of the market. Higher for longer is here to stay. You need to accommodate and adjust and be conservative in your approach is the message coming from him.